Hi, I'm Pattu from freefincal. In this week's fund review, let's take a look at Kotak Flexicap mutual fund. Now, this fund has got quite a big AUM. It's got 36,000 crores, almost 37,000 crores, and um, can such a large fund operate as a flexi cap fund? So that's a question we'll be asking because of its recent performance. Now, this is the market cap allocation history. You can see that from July 2017, well before the SEBI categorization, mutual fund categorization rules, the fund has behaved as a predominantly large cap fund, and it has had a small exposure to mid caps and a very small exposure to small caps. The small caps, the gray area there in the graph, and some amount of bonds or cash in the portfolio, which is the yellow region. Now, after the March 2020 crash, when the mid caps started moving up, so did the small caps, and the small caps have outperformed the mid caps since the recovery. The fund has increased exposure to mid caps, but not as much, just a marginal increase in exposure at the cost of its cash component, but the fund has not changed its small cap allocation much over the years. Now, all this makes you wonder if it is the size that is causing the problem. I mean, if you were to ask, does the size of a mutual fund affect its performance? That's a good question, but the answer to it, a technical answer to it, factual answer is very difficult to establish. Of course, you can intuitively answer it and so on, but that's something that which we don't talk about here. A reader informed me that the fund has changed its benchmark from Nifty 200 to Nifty 500, probably to fit in with a large cap flexi cap definition. Excuse me. Would that mean the fund manager will get more aggressive with the fund's allocation? Is what the reader wants to know. First of all, Nifty 500 is not a tougher benchmark as many people believe, because they have more stocks, more of mid caps and small cap stocks. That's only in number, not in weight. Because if you look at the market capitalization weighting, Nifty 50, Nifty 200, Nifty 100, Nifty 500, all of them are basically large cap indices. So it's not going to be it's not necessarily a tougher benchmark to meet, and that alone is not enough for the fund manager to take aggressive calls. Does the fund manager have the ability to do it is the question that's coming to mind. Now, if you look at the rolling return outperformance consistency, that is, if you take 100 5-year rolling return periods, how many of that did the fund beat the benchmark? Let's say 70, then the performance consistency is 70%. So that if you define like that, then over 1 year the rolling return outperformance is 70%. Over every possible 1 year period since January 2013, over 2 years it is 86%. Over 3 years it's 92%. Over 4 years it's 85%. Over 5 years it's 92%. So that's an excellent track record. There's no question about that. But the problem is, if you look at the trailing returns, that is the last 1 year return, 2 year returns, 3 year, 4 and 5 year returns, the fund has underperformed Nifty 500 total returns index, and it has underperformed by a large extent when it comes to the last 1 year or 2 year and even the 3 year periods. Now, why is this the case? Especially because the mid caps have zoomed up, the small caps have zoomed up. Should a flexi cap fund not have increased its mid cap allocation much more than what this fund did? It's a very valid question. When you invest in a flexi cap, that's what you want to do, right? I mean, when the mid caps are performing better than large caps, you want the fund to be more in mid caps, and vice versa, or the same arguments for small caps and so on. That does not happen for Kotak Flexicap. If you look at what is known as the turnover ratio, the portfolio turnover ratio is defined as the total new stocks purchased or sold over the last 12 months. So they will take the lower value. That is, if the total new stocks purchased is lesser than the total new stocks, the stocks sold, then they will take the new stocks purchased. So it is the lower of the total new stocks purchased or sold over the last 12 months divided by the fund's average AUM. So that's called the portfolio turnover ratio. The turnover ratio, higher the turnover ratio, that means the fund is churning its portfolio. That is, new stocks have entered. The fund has changed its portfolio significantly, and the turnover ratio is in from what I have seen. It gives you an indication of how truly flexible your portfolio is. Now, I had earlier looked at the portfolio turnover ratios for Prashant Jain's two funds, HDFC Top 200, that is the old name, and HDFC Equity. The reason why HDFC Top 200 became HDFC Top 100, I hope I'm right, after the SEBI mutual fund categorization rules is essentially because of the size. After the 2008 crash and recovery, once the recovery happened, a large amount of AUM gushed into these two funds, and that entirely changed the turnover ratio. The turnover ratio was very high. Prashant Jain was able to change significant portions of his portfolio before the 2008 crash, but after the 2008 crash, his ability to do that significantly declined, and therefore the performance of the fund also significantly declined. Now, if you look at the case for Kotak Flexicap, the red line is the AUM. Of course, it is the change in the AUM because of inflows as well as the market movements. It is not just the inflow, but it's the total AUM. Inflow also can be plotted, but the AUM has moved up like that. If you look at the turnover ratio of the fund, that's the black line. As the AUM has gone up, the decline in the turnover ratio is astonishingly large, and currently the turnover ratio is at an all-time low, and it has been at very low since the 2020 crash and so on. So the fund manager has not really changed much of the portfolio. The fund manager has not, or I should say, Kotak Flexicap has not behaved like a Flexicap fund, at least for the last few years, in terms of how much it can vary the market cap allocation and the stocks and so on. That's evident from the turnover ratio. So the signs are worrying. I mean, in the sense that the AUM has increased quite a bit. It's a bank-related mutual fund. That's always dangerous because banks can push aggressively, and the turnover has come down. The fund manager has not he has not kept pace with what is happening in the market. You can say that it is the fund manager's call, but then the proof of the pudding is in the performance. I will say, okay, it's the fund manager's call if the fund manager is victorious. The fund manager has not been victorious. The fund manager has underperformed the Nifty over the last few years significantly, over the last 5 years, in fact, and that is not something small, and therefore the signs are worrying. And although you cannot directly say that there is a link between higher AUM and poor performance, it is all the signs are worrying. I mean, the poor track record, consistently decreasing portfolio turnover ratio, insignificant exposure to small caps. That especially happens when you have a Flexicap fund, which is a large fund. Flexicap fund, as the AUM grows more and more, you cannot allocate significant amounts to small caps because you can't buy and sell them freely in the market. The liquidity is low. The impact costs will be high. So this is the problem. So it is a big problem for existing investors. For new investors, I would definitely not recommend this fund. I would say look elsewhere. The same problem is going to happen with Parak Flexicap in a matter of time. So don't look there as well. But if you look there, you may have to face this situation there. For existing investors, it is a tough call because are you having enough faith to believe that the fund manager can turn things around and can beat it over the long term, whatever that means? Are you willing to stomach this underperformance for a few years, 5-6 years, whatever that has already happened in the past, and I don't know what happens in the future? So are you ready to take do you have that much conviction with the fund manager? If you have, then you can continue. If you don't, well, I mean, you have to consider either exiting or at least putting fresh investments elsewhere. So it is a tough call. The fund has not been really Flexicap. That much is evident from the data.